Hey guys, do you want to know the number one reason that a loan file would blow up in the middle of underwriting? Well, the number one reason that loan files blow up in underwriting is because of debt to income ratio. So the debt to income ratio is a very, very important factor in determining if an applicant can qualify for a loan program or not. Um, the the debt to income ratio can be impacted by income or debts. And so what happens is when we pre-approve somebody for a loan, we do it based on the income documentation that they give us. So their pay stubs, their W-2s, their tax returns, anything that will show what type of monthly income they have. And this income is calculated and converted into what we call qualifying income, which is a little bit different than what an actual income would be. This would be each category of income has a different calculation. So for instance, salary, it is what it is. So if a person receives a salary, that is their monthly income. If they have hourly income, we're going to look at the history of their hourly amount to see if they're always working 40 hours a week or sometimes less, sometimes more. So in that case, we're going to take an average of their hourly income over the last 2 years. And same thing with other variable types of income such as overtime, bonuses, commission, things like that. So where we run into issues with income calculation is somebody might decide to take a new job during the loan process, or since they got pre-approved and then they took a new job, which could be a great opportunity, and it may not negatively impact them, it might positively impact them, but it does change things for sure. So we need to be at least communicated with and updated throughout that process with your buyer. So listen as you're having conversations with them if they're talking about this new job or any changes like this that could impact their income. One of the biggest things that we see that can cause a problem is if somebody goes from a W-2 type wage earner to a 1099. 1099 employees are basically considered in the lending world as self-employed. So when you're self-employed, we need to calculate your income over a 2-year average. And so even if it's in the same company, same type of role, same job description, it's a different type of income. So we will need to recalculate that. And if they switch over to 1099, they're likely going to need to wait 2 years to show what type of income that's going to generate. Another change that can occur, and this I've had it happen multiple times, when somebody has a base salary and then they get a different job within even their same company, and their compensation moves from base plus commission to base plus bonus. Even if the bonus is more, the commission is calculated differently than a bonus, and they each need 2 years of receipt in order to calculate that portion of the income on its own merit. So watch for this. You're going to be our helpful listeners and let us know if you hear of any changes that they're talking about so that we can make sure that we can update the file. Other things that impact the debt to income ratio, and we all know this happens because we all know that we're supposed to warn our clients about this, and we do. We tell them don't make any big purchases. Commonly, people like to buy cars sometime around the time that they're thinking about buying a house. So even if they trade in their car and they get a car with similar value, if their monthly payment changes, then it will impact the debt to income ratio. If it's a new loan, it can delay closing because we need to add that new loan to the credit report, and that can be done quickly, but not at closing. So sometimes that has delayed closing for a day or two while we get the new information, make sure that they qualify for the new payment. The underwriter actually has to re-underwrite the file with that new payment on there. So it can delay things. So buying a car the week of closing, not a great idea. Do not highly recommend. The other thing that can come up is undisclosed debts. So we get the credit report, we look at all the documentation, look for payments going out, but we don't see everything initially. But lenders do have lots of other verification processes going on, and these things do get found out. So we want to know everything in the beginning so we can help, because there's a lot of ways that we can resolve these issues if we don't have to come in behind the 8 ball and then try to fix them. So undisclosed debt, a good example of that would be child support, because it doesn't always show on the credit report, but it is actual debt that we do use in the qualifying process, and how we calculate the debt to income ratio. So I have seen loan files get approved or declined based on $10 of a monthly payment. It can be that close sometimes. So we want to make sure that we're all in communication, all up to date on everything, because the lender will find out. And we want to make sure that your clients get into their house. So be our little ears for us, help us listen, and encourage your clients to be upfront with us so that we can solve the problems before they become big problems. If you have any other questions on this, please let me know. I'm here to help.